Hello and welcome to episode 279 of the Money to the Masses podcast with your resident expert as always, Damien Fay and me, Andy Leaks. Damien, how are you doing?
I'm good, Andy. I'm excited because we finally completed a project that's been going on now, it feels like, for a long time. I think even before you were working on Money to the Masses full time, we started a project to launch a new website, and it finally launched this week. So I'm absolutely buzzing. I know Justin is relieved because Justin's been driving this project forward throughout. And what we've done is go to moneytothemasses.com and have a look around, and you will see that the website's been transformed, and I think it looks brilliant. But what I'm going to do is I'm going to talk around that as one of the pieces on the podcast this week, just to explain to people what we've done, why we've done it, and to celebrate it really, because it's quite a momentous moment in the development of Money to the Masses as a brand, as a company, because we've only changed our site, I think I'm right, on 2 occasions in the 10 years that we've been running. So it doesn't happen often.
It's a big occasion. Normally we come into this podcast and we ask each other how we're getting on, what have we been up to this week. Well, we know what we've been up to. We've been all about the new site, and I have to say, I'm excited too, honestly, to see your face all over the site. It's really refreshing. It's got a new look. You'll go on about why it's different and how it's different later, I'm sure. But obviously that's going to take up one part of the podcast. What have we got coming up on the rest?
So we've still got another 3 money pieces, slightly shorter, to fit into the usual show length. What I want to do is I want to do a quick investment piece, because I changed my 50k portfolio. So I run £50,000 live on 80/20 Investor for members. So I'd made some changes to that this week. And it dawned on me as I was making the changes this week that I always do a number of last minute checks before I actually push the button. So when you're sweating over the point that you've got to click buy, sell, I normally do a couple of things that I want to double check just last moment before we trigger anything. And I thought it'd be useful for people to know what those things are that I look at before I actually press that button. So I want to quickly run through that. I have to talk about the economic statement. So it slightly dates this podcast if you're listening in the future, but the economic statement that was announced by the Chancellor this week had some quite big headline grabbers. So one of them was regarding stamp duty. So I want to talk about the statement, but then focus on the stamp duty holiday that was announced. And finally, it kind of links in with last week's piece on redundancy. Now, we got a lot of good feedback about the piece last week. And of course, it's quite sad to see the news this week where there were tens of thousands of more redundancies announced from big employers throughout the UK. So we've done a kind of follow-up piece, a very brief piece on some websites to look out for where you might be able to use your skills to be able to use to earn some money, because we're in an environment where there are obviously a lot of people cutting jobs. It's not easy to travel to work. We're actually being asked to work from home more and more. So we thought we'd explore the options out there for people who are trying to find some temporary work and trying to generate money from home.
Great. So what are we going to start with?
So let's do the Money to the Masses website. That's the exciting stuff this week. So as I say, if you go and look at the website, you'll see that it looks quite different. And the reason we've done that is because Money to the Masses has changed over the years. So Money to the Masses is 10 years old, and the version of the website that people will know has been around for 6 years, or had been around for 6 years. And as things move on, both in terms of technology, in terms of what we're trying to achieve with Money to the Masses, we needed to refresh things and update the site. So the first thing you'll notice if you go on the homepage, there's a much better user journey with how it works. So over the years, we've had, for example, 80/20 Investor came around. We've had the podcast that didn't exist when we launched the old version of the website. Obviously, the Money MOT didn't exist. So these are things and products that people want to find and use and gain access to. And the old site didn't really help with that. So what we wanted is people might listen to the podcast and they might want to go and find out about some more information about things like the Money MOT, or do some research around pensions. And previously it was a bit clunky to navigate. I mean, it's a very good website, but it was well loved and well used, and we needed to change things. And that's, like I say, because things have moved on and technology now allows us to do some really good stuff. So if you look at the homepage, for example, you can listen to the podcast. You can listen to every episode from the podcast straight from the front page. So the latest podcast episode appears on that page. You can click through to the post that we've been mentioning quite a lot lately, that we have posts for each episode. You can go and find the others, but you can go to the MOT and 80/20 to look at that. But you can also go through the different categories at the top, and you can see that we can pull out the key content that other people find most useful on Money to the Masses. So if you want to read about pensions, you can go into a pension section and you will see the key content that people find useful, and we can highlight that. So it's not just a list of latest articles, which is what happens on most sites. And the technology behind what we've done, I mean, this is a testament to Justin and the team behind building the new site, is that in the future, it can be tailored much more to the individual, that people be able to see the stuff that is relevant to them. And that's something that's really exciting, and no one is doing that out there in the world of money. So the site has taken us on a journey, and we're now at a point where we needed something new. One thing you will obviously notice is that you'll see more of me on the site. Now, that was something that came about because of demand, really, research that we've done into it. And what happened is people would perhaps look at the site or come via the podcast, and we wanted the site to have a bit more personality about it, so people could see that this was the right place. It was related to the podcast. So it gives a lot more personality to what is going on on the website. So you remember probably it was about 18 months ago, I did a photo shoot and bits and pieces to be able to provide those photos. So that's quite good to see that. I mean, unfortunately for you, Andy, it means you've got to not only stare at me in the office, but you've got to look at my face on the homepage every day. But it's a definite step change. And I think it's something that will be quite exciting for us as a brand and going forwards.
The way the site works, I like to liken it. Have you ever been on YouTube or maybe on Facebook, and you look at a video of a cat and you really like videos of cats, and then you'll get served another video of a cat and you think, oh, I really like this. And then you keep getting served the stuff that you like and that you consume and you enjoy. Well, the website kind of works a little bit like that. So if you get drawn to the website and you want to find out about pensions, then the likelihood is the next article that will come up is something also about pensions that you might want to be. It's relevant and it works and it keeps you on the site and interested.
Yeah, and one of the other things is people are always asking our views on products or services, and while we produce a lot of reviews on those products and services, there was no way for people to find them in a succinct way. So what you will find now is if you go into those key areas, whether it be credit cards, whether it be, like I say, pensions, investments, you will see products that are rated there and links to our full-blown reviews on each of those things. So it means that people who like what we do at Money to the Masses and want to support what we do, they can now use Money to the Masses as a complete hub for them to be able to sort out all of their finances. That was always the aim, but because of the way the old site developed, it wasn't quite that linear journey, that hub that people could use. So that is what's happened with Money to the Masses website. It looks fantastic. I really do like it, and it's incredibly fast to use. So the message is go on the site, have a look around. There will be odd wrinkles, which we've had a team from the Money to the Masses Facebook community who have signed up. They're going to get exclusive mugs. They're helping iron out any crinkles and any glitches. There are always glitches when you launch something. I'm amazed how few there are. In fact, that's down to, again, the work that Justin and the team behind him have been doing, but there will always be some. So if you notice anything, then do get in touch. Email us. Damien@moneytothemasses.com is the email address, and I'll make sure that they get sorted. So it's great to see years of hard work come together into something that looks fantastic.
Actually, you mentioned years of hard work, and I've just realised when I was trying to give an analogy, I basically likened those years of hard work to looking at cat videos on YouTube. So I do apologise for that. There's a lot more to it.
Well, a lot of your work's in there as well, Andy, so I don't mind. I like cat videos. So on to the next part of the podcast. So the investment piece is the next piece I want to go on to, and it is regarding making fund switches or changes to a portfolio. So I'm going to run through this list in no particular order, and they're last minute checks I sometimes make when I make a fund switch. So one of the key ones is the charges that are applied to your investment. So you want to go from fund A to fund B, then you need to make sure what are the charges that are going to occur. Now, if they're both unit trusts, and on most fund platforms there won't be a fund switch charge, although some do apply them. So you need to know what that charge is, how that relates to the size of the fund, so the amount of money you are moving. So if the charge is a fixed amount, then the bigger the fund, the smaller the charges and the percentage wise. So it's important to know what you're going to be charged in that regard. Also, if you move from a unit trust, for example, and you want to go to an ETF, you need to be clear about the process of how that works, because a lot of people will be doing that. They'll be increasingly buying ETFs in their portfolios, maybe alongside unit trusts. And I mean, I've done the same thing with my own portfolio. But there are timescales that occur. You need to be aware of how it works. So normally with a fund switch, it is treated on most platforms as a transaction that's a sell and a buy. Some of them clump it together, but it's usually a sell and a buy. What happens if you want to go from a unit trust to an ETF is that you have to sell, get the money in cash, and then buy the ETF because it's transacted instantly. So you have to be aware of that. You have to know how it works. Is there something else you're expected to do subsequently once you've made the switch? You'll be aware of that straight away, because if you try and switch from a unit trust to an ETF, they probably won't let you. They'll probably just say you can't do it. But that shouldn't put people off. They might think that they can't hold them. You can. You just need to have cash available before you buy an ETF. The other thing I think is a big one is the bid offer spread on funds. So on funds, you sometimes get a bid offer spread. So there's two different prices. There's effectively a buy price and a sell price. Now these prices work as a charge, so almost a percentage. I always go and look on a number of platforms for the current prices of a fund I'm looking at. So some platforms seem to only show one of the prices, whereas Hargreaves, for example, Hargreaves Lansdowne, show both prices. They all should show both prices, but I've had points in the past with the platform that I've been using where I question whether both prices are being shown correctly. So the reason I look for the two prices, because they should be the same. Hopefully, if you've got a clean fund, one where the charges are at their lowest, you're not paying excess commissions or anything, they should really be the same. And if they are, you're not being charged an entry fee, because a bid offer spread acts as an entry fee. And if there is one, you might want to work out what the percentage is, because then you can again think, is that worth paying to be able to get into this fund? Often it's not, but sometimes it's only very small. It can change. So make sure you look to see if there's any extra charges for going into a fund. I've heard of people in the past think, I want to go and buy a particular fund. Yep, love it. Looks great. I want to buy this fund. You go and buy it. And then when they look at their portfolio valuation, they realize that it's 5% different. And they've now got to make up not 5%, because obviously the way percentages work, you've got to make up more than that to get back to where your portfolio was when you invested. By that, I mean, if a portfolio fell 50%, it's got to grow 100% to get back to where it was. So the percentages are bigger on the way up. You've got to secure. So make sure you know whether you're paying that. Fund houses like Legal & General quite like having bid offer spreads. Some of the old Schroeder funds and BlackRock funds, they have them as well. So just make sure you know what they are. Make sure you know the charges applied to investment trusts and ETFs, and how they are applied. So normally, if you buy an ETF or an investment trust, there will be a separate charge for that transaction, and it will be a buy on the way in and a sell on the way out, and there'll be two charges normally. So it could be like £10 and £10 making 20. You've got to factor that in. One other thing I would always look at is the performance of the fund. I would do a last check on the fund performance. And part of the reason I do it is to make sure I've got the right fund. I get lots of emails and questions from people regarding funds. How do they know that they're picking the right one? What does it mean with all these different share classes? And the share classes often are there because there's different charging structures, but fundamentally they're the same fund. They're the same investments lying underneath. The best way to make sure you're buying the right fund when you get multiple options on a fund platform, which you will do often, is to go and look on Morningstar. Find the share class of the fund that you've got. So it might be a fund that will be, let's just say it might be, I don't know, Jupiter Japan X class, and there might be an A class of the same fund. Your platform may only offer one of them. You may be looking at a version from somewhere else that you've decided, oh, I like that portfolio I've seen over there in some recommendation or something like that. You go to buy it, but you've got a different share class. If you use Morningstar, you can chart the different share classes, and therefore you can make sure they are the same thing. There'll be a minor difference, maybe. I mean, we're talking like fractions of a sort of decimal place over a year or so, and it'll be down to charges. What you're really looking out for is where there's something quite crazy going on. And that could be a sign that you've got the wrong fund. So you might have a same fund, but it might be an income version of it. Now, I'm not talking about income units. It might be just a slightly different fund that might be called, I don't know, Japan Income or something like that. The other thing, it could be a hedged version of a fund. Now, this is something that comes up every now and then, that if you buy an overseas fund, some providers offer hedged versions. So again, let's talk about Japan. You may want to invest in Japanese equities. If you've got a hedged version, you're only getting the movements in the share price as priced in yen. So imagine if it was the stock market, the Japanese stock market, and you're getting those moves. If it's unhedged, you're going to have a currency fluctuation and impact. So if the pound falls like it did after Brexit, you're going to get a nice currency kicker because your assets that are now priced in yen are worth more pounds than they were previously. So you want to make sure you buy the right version of a fund because you can't assume they're identical. What will happen if you chart them against each other? Very quickly, you'll go, whoa, they aren't the same. There's something else is going on here. And then you can look closer and think, God, I did nearly buy the wrong fund there. So I always do that no matter how sure I am, just to make sure it is the right fund. The other reason I look at the performance figures just at the last minute is it might have been part of my research, but I also want to just double check what's been going on recently and therefore look at how it's performing against its peers. Has something fundamentally changed in recent times? Has it suddenly tanked? Is there something going on that I'm not aware of? That could flag up some issues maybe within the fund itself, the way it's being run, or something that's going on. Just look at Neil Woodford. His fund values were plummeting as people were trying to pull money out of the fund. As much as fund managers try and protect the underlying holders, still it might flag up that other people are fleeing the fund. Maybe they know something that you don't. The other reason I always look at the performance, not just in the last sort of months or so, maybe a bit longer, just to see how it's performed versus peers, but particularly in downturns and periods where the fund did badly. And you want to know when that was and how did everybody else perform, because it may flag up what will happen if we have another slump. And you're always trying to protect capital when you're investing. It isn't always about shooting the lights out. Equally, you might want to look what happens when the market rallies. I'll give you an example. I was looking at a fund this week and it was an Asian equity fund. And when I looked at it, it done really well in the last month, really well compared to its peers. And then that got me starting to look a bit deeper just at the assets that it invested in. And when you looked at the fund fact sheet, I did a podcast recently about how to read them. If you look at the fund fact sheet for the provider, you can sometimes find them via sites like Morningstar or go directly to the fund house. You will see the top holdings or the geographical split. And I could see that it was invested in Chinese equities. Only had 40% in Chinese equities. I say only, that's quite significant, but it wasn't all Chinese equities. Yet I then mapped that against the Chinese equity index. You can do these things on Morningstar and other sites are free. And it moved in tandem. So really, this Asian fund was really a quasi-Chinese equities fund. And so at the last minute, I then decided, you know what, I'm going to relook at this and reconsider it because it isn't really an Asian. It looks like an Asian fund. It's named an Asian fund, but it really behaves like a Chinese fund. So those last minute checks, you can then start to see how it might impact your portfolio. The other thing is check to make sure that any fund that you buy, now particularly investment trusts and ETFs I'm talking about here, whether they apply leverage, so that means whether they borrow money to try and gain more money, to sort of amplify gains, but they also amplify losses. So you want to make sure, I mean, my view, I would try to avoid funds with excess leverage because it makes it more risky, increases the chances of you losing money. Check the accumulation or income units. The accumulation, what it means is that the income is rolled up into the price of the fund. It's accumulated. Income versions, you can take the income out if you want to, but you just normally choose to have it reinvested if you're still growing your portfolios. Make sure you know which one you want and pick the right one. One other thing as I try and look at is the asset mix of the portfolio once I have this new fund. And you can start to back test portfolios and how they might perform. Even if you just look at the total return, not even if you can't chart it because you can't build a fictitious portfolio maybe with your platform. I do that with the tools that I have, but you could just look at the total return of each fund in your portfolio, say over a given period, maybe a slump like we had in February, work out what the return would be assuming the proportions that you have but with the new fund, and you'll be able to see, would my portfolio perform worse than it did during the coronavirus downturn now if I had this new fund, or will it be a little bit more defensive? And you want to make sure that it's doing what you want it to do. So if you want to not take more risk, then you need to make sure that new fund doesn't add more risk. And the last 2 points I want to quickly say is the time of day you're doing this. So every fund on a platform, and the platform itself will have a time scale which you have to place a trade, particularly in a unit trust I'm talking about here, where the price point is decided. So I will give you an example. Fidelity tend to have 11 o'clock in the morning as the cutoff. So if you want to place a switch on a unit trust, you need to do it before 11. But individual funds can also have their own switching points. So if you want to make a switch, you're better off getting up in the morning and doing it there and then. Then what will happen is your fund value will be determined at the next price point. You'll then be out the market normally for a day before you buy back in with the unit trust. Slightly different with ETFs and investment trusts, but you want to make sure when you do your fund switch that you do it in the morning, because who knows, if you were to do it at night time and we're about to enter a world war overnight and you wake up the next morning and you've done your fund switch, you might not want to have made that decision. You can't time the market, but you want to do it as close as the point of which the transaction takes place, and that means doing it in the morning for me. And the other thing I would just want to finish on is Google the fund name that you're going to buy and Google it in the news section of Google. So most people will know what that is, but if you put anything in Google, above the search box, there's normally news. And the reason I say that is because you will find out whether there's been any detrimental news regarding this fund. Maybe it's closing, maybe it's had some issues, fund managers leaving, or whatever it is. It may be something that you want to consider before you invest into it. And for example, with a lot of funds, it could be that you start to see it mentioned in a article that's talking about it appears to this fund that might be closing. So let's say you're going to buy a property fund before they all closed. Your one might not be, because that's why you can buy into it. But if you'd read an article, you'd have probably been compared to others that were mentioned that were being closed. And it might be a bit of a wider story, like it was when property funds, direct property funds closed that were unit trusts, that could impact your fund if you're about to go into it. And it may cause you to change your mind. So those are just some of the checklists. It's not a complete checklist by any means. If there's anything else anybody else thinks of, then email me and we'll share it on the podcast. But they are the sorts of things that I look at quickly before I press that buy button.
Okay, so moving on to the headline grabbers from the most recent economic statement. What has Mr. Sunak been up to?
He's been printing, well, he's not been printing money. He's been firing money and spreading it around at an unbelievable rate. I mean, I watch what goes on and my jaw is almost on the floor. This is so unprecedented in what is going on to try and stimulate the economy that on the one hand, I'm impressed by the imagination in terms of the policies that they come up with. They are really thinking outside the box. But there's another part of me that's also thinking, blimey, these things must be pretty bad in the background if we're having to resort to this. And we haven't seen the economic numbers to prove just how bad it is. And also, there's no such thing as a free lunch. And I'll come on to something about free lunches in a minute. And we're going to have to pay all this back at some point. So it's a bizarre world. You would never have believed it. Go back 6 months, we'd have a government that is throwing money everywhere, just billions and billions, almost relentlessly. So there are a number of announcements regarding jobs. Now, the job retention scheme will be phased out, so that people being furloughed from the 1st of July and will end on the 31st of October. So we already knew that. But now there's going to be a job retention bonus. And it's going to be introduced to encourage employers to bring back workers from furlough. And that is £1,000 bonus that will be paid per employee returning from furlough. And there are some rules around it. I mean, they have to remain in work until at least January 2021. And they have to have been paid at least £520 per month from November until the beginning of the year. The point being that employers are being given cash incentives to bring their employees back to work. And don't forget, those wages are already being paid as well over the summer. There are also something called a Kickstart scheme they're doing, where they will pay employers to create jobs for 16 to 24-year-olds. And there will also be apprenticeship scheme. Well, what they're going to do is they're going to pay a £2,000 bonus for each young apprentice role created. And so there are slight nuances in this, which you can find online. But it just shows you they're trying to get the country back to work. But obviously, as I mentioned earlier, we're actually fighting a bit of a battle here because there are lots of companies making people redundant. Before I go on to the stamp duty point, which is the key one, there was another interesting point that goes back to my free lunch pun. And it's about this idea of eat out to help out discount that they've created. So the government is going to provide a discount of 50% on bills up to a maximum of £10 per head at participating restaurants, cafes and pubs from Monday to Wednesday in the month of August. Now, this is like...
that is just brilliant. It just sounds like some madman's just reeled that off.
It sounds like one of those ideas that you would get do you remember in the election, you get the guy with the bucket on his head? He always follows the Prime Minister and always tries to get elected in his seat, Lord Buckethead or something. Yeah. He'd come up, we're going to just give everybody free restaurant meals and things like that. That is, I mean, to me, mind-blowing. But in August, they're going to try and encourage us to go out and eat because you're going to effectively get half-price food in restaurants. So if that wasn't dramatic enough, the stamp duty announcement was one that started to get leaked the week before. In a nutshell, they're temporarily raising the stamp duty threshold to 500,000 until the 31st of March 2021. What that means is that if you buy a property, then if the property is valued under £500,000, you won't pay any stamp duty. If the property is worth more than £500,000, you just don't pay any stamp duty up until the £500,000 part of the price, and it's therefore staggered and tiered above that. What it means, if you work out the numbers, previously there were bands where there was no stamp duty up to £125,000, 2% between 125,000 and 250. Then the next 675, so that was 250 to 925 was 5%. From 925,000 to 1.5 million, it was 10% stamp duty. And if you're lucky enough to buy a house above 1.5 million, then it was 12% on the portion above it. So each of those percentages I've said, it was always working on the portion above each band. So each band, your house price fell in, that portion would be charged the relevant rate of stamp duty. Well, of course, they've got rid of the first couple of bands now, and it goes straight to £500,000. Now, that is massive because it means that potentially you could save £15,000 in stamp duty if you buy a house that's worth £500,000 or more. Now, you can understand that has lit a firework under the property market. Now, I only say this, I know it's only days old, but we talk to lots of people in different industries, and one of them is in the property industry and estate agencies. And to give you an idea, I think Rightmove announced they had their record day of people clicking on their website the day that this new stamp duty rule was passed, and it's coming with immediate effect. Talking to estate agents, one in particular said that they'd had like a dozen offers for houses the next morning and were having more coming all the time and having to ring up sellers to try and get those agreed. So it just showed you there's obviously a pent-up demand. People who want to move are now being incentivized to, because there's a potential saving of £15,000. Now, what is interesting, if you dig into it, this isn't universally beneficial to the same extent. So first-time buyers, for example, they already were exempt from stamp duty up to £300,000. So they already had an exemption. Now, this rule just means that for most of them, that level of stamp duty-free threshold gets increased slightly. It means that they could potentially save up to 10 grand in stamp duty now, when you look at the numbers. But other people in the housing market are buying further up the chains, they can save a lot more money. So the argument is that first-time buyers are really only keeping what they already had, whereas everybody else in the property market is benefiting from this stamp duty holiday. And of course, that could push prices up. If the demand in the initial days that we've seen doesn't start to ebb, then that would suggest that prices could be pushed up. Anecdotally, I've seen people talk about houses they were looking at, the price went up 10 grand in the very next day because obviously people realise that their buyer now has £15,000 potentially more to offer. But then that's going to happen all the way up the chain. But what it's done is it's meant people are now more inclined potentially to move. And if somebody was thinking of moving in the future, it's brought it forward. Of course, if you talk to estate agents, they will just tell you the reasons that people move still remain the same. That is always going to be the case. This has just probably brought forward a few transactions or sparked a bit more interest. Don't forget, the one issue you still got with all of this, that there are people being made redundant, the economy is still struggling, and mortgage lending is getting more difficult. So a first-time buyer is going to find it more difficult to get a mortgage now than, say, 6 months ago. The number of products with a loan-to-value of 85% or more, so basically the more you want or need to borrow versus the house price, they are reducing. In fact, above 85%, there's barely anything out there. So it means that first-time buyers who have small deposits aren't benefiting anyway from this. And I've heard anecdotally as well that more mortgage providers are pulling some of their products. So we've got to let the dust settle to see what the impact is. But first-time buyers aren't really winning from this. It's people further up the chain. Landlords, interestingly, also benefit from this, which has been something that's been slightly contentious because they are benefiting from the holiday just like everybody else. And of course, the government previously had been putting in place measures that were trying to limit the advantages that landlords had when it came to buying property. And they still have to pay the additional stamp duty rate of 3%, but they do not have to pay the basic stamp duty up to that £500,000 level. So that'd be 0%, but they still have to pay the extra 3%. It does also throw out this other idea potentially that if there's somebody who has their own house they live in and they have a second property, if they sold that second property and maybe they had to pay capital gains tax, then maybe they might be inclined to sell it now and move at the same time, because if they moved house, the saving they have on their stamp duty on their main residential property could potentially offset the money that they would have had to pay in capital gains tax. So I think you're going to see more transactions that are going to take place. And I mean, one of the arguments for prices going up as well is because if you don't have to pay so much stamp duty, generally, I'm talking about most transactions, then you're going to be able to afford to pay more for the house that you want. So another reason why house prices could potentially go up. House builders apparently are meant to be pretty pleased about it. I'm not surprised. I think it helps them plan a little bit more going forward in terms of what could happen with the housing market. And estate agents are clearly quite happy. So there are winners and losers across this whole thing. But it's one of those measures that disproportionately favours different parts of the country. So the North East, apparently, the average saving will be £646 in terms of stamp duty. And that's because of house prices in the North East are lower than London. Whereas in London, the average person will probably be saving much nearer the £15,000 amount, which is the maximum. So different people in the country are going to benefit from different ways. So again, there are big winners versus people who have small wins. But just to give people the highlight, if you buy a house, the first £500,000 has 0% stamp duty. From £500,000 to £925,000, it's 5% stamp duty. From 925 to 1.5 million, it's 10% stamp duty. Again, it's all done in each tier, so each part of the price that's in each box gets charged that rate. And anything over 1.5 is charged at 12%. So you can see this is quite a dramatic announcement. It's one that's getting a lot of attention, and it'll be interesting to see what happens going forward.
One of my concerns is what's going to happen further down the line. Is there going to be a huge sort of full stop? What's going to happen midnight come the end of March 2021 when everyone's pushing to get moved? Is the housing market just going to stop?
I mean, some of the concerns that have been raised out there, and I've been reading a lot of opinion on it, and that is one of the big concerns. They're saying that when you get these measures, they're great when they come in, but as soon as you get near that point, the uncertainty means that people are therefore likely to not do something, or it's going to, the cliff edge is as soon as there's uncertainty, that starts to impact people's behaviour. So who knows? We may get it extended. I think
that's likely, personally.
I think it's one of those things that when you get a cliff edge, you're going to move on, because what it would do is for some people, what happens, people tend to move to the full extent of their budget. This will be a make or break. So £15,000, where they're going to find it, they just can't move. And so that will mean it'll fall apart. That cliff edge is something they don't want. And if the coronavirus hasn't disappeared by then and the economy's still struggling, they certainly won't want to cause anything to make the market collapse. I know there'll be people who are listening to this podcast, and I know there are a couple of people in the Money to the Masses team who've bought houses in the last 6 months who will be looking at the amount of stamp duty they paid. And I mean, they're fairly sanguine on the whole thing. You have to play the game that's in front of you. You don't know this is going to happen. But there are people who are trying to push for people who moved during lockdown to get a refund of the stamp duty, because the argument being that they supported the market by making a house purchase when it was difficult. They have been penalised by not waiting until it finished. So don't be surprised if that becomes more and more vocal. I don't know if that will happen. I don't want to get people's hopes up, but don't forget that there were people who in the initial stages of furloughing were excluded from the scheme, and then they moved the start date from which you had to be employed further back to include people at the point of lockdown that were also employed at that point but then had been made redundant. So there is a slight precedent, but we'll have to wait and see.
One final piece I have on it is the language that they've used in terms of announcing it. They use the words holiday. Now, we've all talked about mortgage holidays, and we understand what a mortgage holiday is. It's basically you don't pay it for a little while, but you still owe it. It's added on at the end. And when I heard people talking about a stamp duty holiday, I assumed straight away that this money would somehow be owed further down the line, but it's not. It's not a holiday. It's basically a freebie.
Oh yeah, it's almost like an amnesty that you can move around and not pay that tax, which is quite incredible. But there you go.
Okay, and so the last piece of the podcast is kind of following on from what we were talking about last week about redundancy. We're seeing some, fairly depressing news about the rising numbers of redundancies in the UK, and it's probably set to increase as time moves on. And with the world that we're living in at the moment, with lots of people having to work from home, it kind of made us think about all the different ways you can earn money, and especially earning money from home. And there are lots of different websites and ways that you can earn money using your skills.
Yeah, so we're not just talking about flogging stuff on eBay or anything like that, which is obviously you could do, but this is about people who have a skill set they might use in their day job. It could be something like they are good at editing or proofreading or something like that. You can make money online with those skills.
Yes, there's a few different sites I'd just like to quickly run through. The first site I looked at was a site called Elevate Direct, and they really specialize in technology, people with IT skills. And the idea is that they match people together. So there will be companies out there, enterprises that are looking for skilled talent, and there'll be people out there who have got those skills. So the website will marry those two people together. So you can, if you've got the skills, you can log on there, add all your relevant skills, your price, and then if there's a company or an enterprise that needs that kind of job done, then the two are matched together.
And you're paying basically almost like a contractor, freelancer.
Yeah, and you're cutting out the middleman. You're not having to pay recruitment agencies. You're not having to pay talent managers. You're basically bridging that gap, and you're just going from A to B. So Elevate Direct is really good for IT people in the technology industry. Onsite.io is the next website to look at. Now, this is a specialist by invite only website, which sounds a bit strange. They're kind of looking at higher skilled project managers, developers, designers. So anyone can submit their sort of CV online, but you need to be accepted by them. So it's not for everyone. It's basically the elite. So I find that a little bit depressing that you submit your skills on there and they say, you're not good enough. But if you are highly skilled and you do get selected on that program, then it can be very lucrative.
Good for you, but yeah.
There are a couple of other sites which are kind of marketed more at the lower end in terms of how much you can earn per job. But because there are so many people on there that need jobs being done, then there seems to be quite a high turnover. So you could do 5 or 6 quick jobs and quickly earn sort of 10, 15, 20 pounds. And it quickly adds up. So there are 2 sites there, Fiverr, Fiverr, and name of that site kind of gives a clue as to kind of the price of the jobs that you're looking at. It's quick jobs, so it could be things like processing data on Excel spreadsheets, maybe designing a wedding logo, that kind of stuff. So if you've got those kind of skills, then get involved. And TaskRabbit is another one. So if you can build cabinets, if you can paint a wall, if you're a handyman of any description, it's those kind of jobs, those kind of skills. If you've got the time, you can pop your details in, your postcode, your area of expertise, and you'll get matched with people who need stuff doing. I actually know of someone who does TaskRabbit, and a retired gentleman in their 60s, handy with their hands, and they'll go round and help people, I don't know, dig a flower bed, or they'll put up a picture, or, and they earn 10, 15 pounds a time. I think it's quite a
nice idea.
Yeah.
What are the last ones?
The last couple of ones are Upwork and People Per Hour, and they're very similar. They're basically broad ranging, lots of different skills, lots of different jobs on there. Again, they match the people who have got the skills with the people who need things doing. And you don't need to be a specialist in any particular area. There are all sorts on there. So they're kind of broad ranging.
Good. Like that. Good. That's a good piece. Good bit of research, Andy.
So that's it for this week. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. Twitter, it's at money to the masses with number 2. Don't forget, we're on Instagram and YouTube.
Oh, we hit 2,000 Facebook members this week. I can't believe we didn't even mention that at the beginning. We got so wrapped up in the website. That was fantastic. We hit 2,000 members, given that it only started at the back end of last year. So we managed to do that organically through all of you coming together in the community. Well, not all of you. So the ones of you who listening who are in the community, get in there. There's some really good stuff in the community where people discuss a whole range of topics. For example, the stamp duty cut. That was discussed in depth in the community, different people's views on what's going on. And the other thing, actually, before Andy finishes off, reviews. Do leave a review on the podcast. You'll see it makes a massive difference. I often tweet or write about them when I get them, because they're very good and very motivating. And there was one this week that I was going to read out, but it actually likened me to Martin Lewis, funny enough, which I thought I'll take as a compliment.
You should do. Well, that's it. We are done for this week. So until next time.
Until next time.